Hello, I'm Kumar from Cherry Academy. Today, I want to make a little video, which I hope to continue on OT questions in all subjects from CA1 to CA4, BA1 to BA4, P1, P2, P3, F1, F2, F3, E1, E2, E3, and also on the case studies. But today, my first attempt is on F3, financial strategy. I want to look at a few questions on debt finance today. How to answer these questions in the shortest possible time, and sort of how we can manage that 90 minutes to get the maximum marks and to get through these hurdles one by one so that you can become a CGM. So I'm Kumar with almost 15 years of experience of CIMA online tutoring. I'm FCMA, and today let's look at some of these questions in debt finance. So you can see these questions, and I will be looking all these questions with you. 10 questions here are to answer in the PowerPoint. I put up some slides to explain each and every question. So this is your question number 1. This is your question number 2. In the 60 questions in the 90 minutes paper, you get some easy questions, some difficult questions, some scenario-based questions. So I put up in most of the situations some scenario-based questions. Each question carry 2.5 marks. Out of 150 marks, you have to get 100 marks to get through the exam. Even though each question carries same marks, time-wise, it's not same. Not that every question will take 1.5 minutes. Certain questions will take 15 seconds. Certain questions will take 2 minutes, 2.5 minutes. So the balancing those things, the time of 90 minutes is so important, which we will discuss in our future sessions. So I'm Kumar. I give tuition through Cherry Academy online with some other panel of tutors. And we have had hundreds of successful stories all over the world, starting from certificate level right up to the strategic case level. So if you're interested, you can contact me on WhatsApp +94 77 321 9387, or you can contact me on email cherryacademylk@gmail.com. You can visit our sites, the Facebook page, Cherry Academy Private Limited. Also, you can visit Learn with Kumar, and there'll be many YouTube tutorials coming up. So these are the questions we'll be looking today. And if you need these questions in PDF format, just send me an email, cherryacademylk@gmail.com. Certainly, I will provide all these questions. And the slides, which I'm going to do today with the answers, is available. If you want a set of slides copies, just send me an email. I will do that also for you. So the question number 4 is a bit of a long question. So probably when we have a long question, sometimes like this, maybe you might want to flag it and go for the other question, the next question, because the idea is somehow you must, in first round, attempt all 60 questions. Because some of those questions towards the latter part, maybe 56, 57, 58 may be easy questions. Because if we struggle in the earlier questions, we might not reach those questions. So better thing is to, if you are struggling, flag it and go for the next question, and next question, and go right up to the 68th question. Then go for a second round, unflagging and trying to answer every question. So this is also a question, probably if you know the time, if you know the answer, maybe just 5 minutes, 5 minutes, 15 seconds, you can answer this question. This is probably again a 15-second kind of question. So you don't need to spend 1.5 minutes. Actually, you should not spend 1.5 minutes. If you spend 1.5 minutes in a question like this, you might struggle to find time for some difficult questions. So that's the idea, trying to get these marks. This probably will take little time, but surely again, an easy question. Again, another easy question. Fairly all right, this one, again, a calculation question. This looks a bit of a long question, which will take little time. So you will find easy questions, easy but time-consuming questions, difficult questions, probably which we have not studied. I mean, it's natural that we are unable to do everything. So there may be certain questions that we are left over. So don't worry about all that. Have confidence when you want to answer the paper. So I'm going to look at each one of those 10 questions. And I'm going to discuss some of these things. So again, Cherry Academy, I'm Kumar, FCMA with 15 years of tutoring experience and 45 years of practical experience. And I now do almost every area of CIMA subjects, including the 3 case studies of operational, managerial, and strategic case study. Lot of success stories. Later on, we will put it in our website, many of those success stories. This morning, we had a student who was very reluctant to sit for the exam, but we pushed her with so much of confidence, and the end result was she passed P3 with very, very great results. Right. So let's look at our question number 1. So we are Toddler PLC. CF is contemplating to borrow 500,000 for a long-term toy manufacturing project. They'll require funds in 2021 June. CO wants to borrow on fixed rate loans, whereas CFO is keen to borrow on variable rates. So you can see the 2 top people have 2 different reasons. CO is thinking in terms of borrowing fixed rate. CFO is thinking in terms of borrowing variable rates. They must be having their own reasons. But the question is, which 3 of the reasons would support CEO's stance on borrowing? So we must understand the question. So we don't need to worry about CFO's stance. We need to look at from CEO's stance. What is CEO's stance? It is why he should go for fixed rate of interest. So we need only 3 answers. So if we can find the 3 answers, we have done the justice for the question. And that's all we need to look at all the time. So let's look at interest rates are likely to drop by December 2021. Now, if we borrow fixed, and if the interest rates are going to drop, right? In other words, the LIBOR rates or whatever it is going to drop, it will be a big disadvantage if you had borrowed on fixed, because it's a long-term loan, so you can't change it. and you will be committed to pay higher rates of interest, whereas the rates in the market is coming down, which will give a competitive advantage for your competitor if he's going to borrow variable. So it's not a good reason if you believe that the interest rates are going to drop by December 2021, we are in June 2021, or they require funds in June 2021. I don't think it is a right strategy for you to go and borrow it fixed. It is easy to negotiate fixed interest rates with lenders. I think it's the other way about. It's easier to negotiate variable rates with lenders because the lenders also is looking from risk management point of view. Every time when the variable rates changes, it's easy for them to fix the rate because it's pegged to variable rates, maybe LIBOR, whatever the rate. But when it is fixed rates, the lender will have to take certain amount of risk, and therefore the negotiation can be a bit harder. So A and B are not the answers in favor of CEO's situation. It will increase cash flow certainly and will help planning cash flows. Surely that is there. Because what we know is whenever we go for fixed, our cash flows are very certain. We can plug the cash flow straight away. By having a mixed portfolio of variable and fixed loans, it will help to reduce the interest rates risk. That's also true. Because if we have a mixed portfolio where we are paying certain loans, fixed rates, certain loans, variable rates, here we can see immediately when the rates come down in the market, by having variable loans, we will be at an advantage. When the rates goes up in the market, by having fixed rates, we will be at an advantage. So this is a good reason why we should go for at least some portion of the loans with fixed borrowing. And that's your stance. Interest rates are likely to rise by December 2021. Surely, if the interest rates are rising, the best thing for you to do today is to go for fixed loans. So you can see C, D, and E are the answer. Now, what I want to tell you is in your exam, the moment you know that A and B are not right, and when his examiner is asking 3 answers, and there are only 3 more, if I was you, I will not even read C, D, and E. Because I know A and B are wrong, and there are only 3 possible right answers, and that has to be C, D, and E. Learning, we will read and understand it. But in the exam, I don't need to do that part. I know A and B are definitely wrong. I need only 3 answers, and there are only 3 more answers. So I can just go and tick C, D, and E. This is what we should try and do it. That way, you can save time. So the answer should be C, D, and E. Then we have the question number 2. So what is question number 2 is all about? So Blackfoot decides to buy, so let's read the whole question. Decides to buy a delivery van on lease, signs a lease on 1st January 2021, prepares financial statements in accordance with IFRS. So now we know we have this IFRS 16, where Blackfoot become the lessee. And when it's a lease for a period of 5 years, it's going to be a finance lease. There are only 2 what we can consider as non-finance lease. That is when the amounts are very insignificant, less than $5,000, or the lease is less than 1 year. Otherwise, every other lease, from the lessee's point of view, it's a financial lease. So from Blackfoot's point of view, it's a finance lease. Under the terms of the lease, 5 payments of $6,000 per annum are to be made, with the first payment due on 31st December 2021. So we are entering into lease on 1st January. 31st December means we are paying it in arrears. That is very important to know whether we are paying it in arrears or whether we are paying it in advance. The cash price is 24,000 and we are paying 6,000 into 5, 30,000. So that means there's 6,000 what we are paying excess, and that's what we call finance charges. You are preparing the budgeted statement of profit and loss and other comprehensive income for the year ending 31st December 2021. So maybe you're a little too late, but you are just starting the budget and now you are preparing it 2021 budget. How much should you budget as finance charges to the nearest dollar to be included in the statement of profit or loss and other comprehensive income budget for the year ending 31/12/2021 using the sum of digits method? So read the question slowly, try to find out what they're asking. So what are they asking? 31/12/21. So that is our very first year of operation. How much we should charge as finance charges under sum of digit method. So what we do is we look at, okay, it's 30,000 is your lease payment. $6,000 into 530K. Cash price is 24K. So that means we are paying 6 finance charges over a period of 5 years. So when it is sum of digit method, what we do is, since it is 5 years, we put 5, 4, 3, 2, 1. So for the first year, we have to take the number 5 digit. Second year, we take number 4 digits. So actually, I don't need to go so far because I'm only looking for the first year. So I don't need to work out all 5 years. I need to work out only the first year because I'm looking for 31/12/21 finance charges. So this is the way that you can save time. So the sum of digit method, the SD, is equivalent to when it is paid in arrears, it is n times n plus 1 divided by 2. So n here is 5, then 5 plus 5, 6 is 5 plus 1 is 630, divided by 2 is 50. So your sum of digit is 50. So what we do is, okay, we take the first year, we have put it up backwards. So 5 over 15. My total finance charge is 6,000 because 30 is the lease payment, 24 is the cash payment, 6,000. So I can find out straight away what is my finance charge. So my finance charge is, for the first year, it has to be 2,000. So my answer is 2,000. That's all. I don't need to think about second year, third year, fourth year. Okay, if they ask for second year, third year, fourth year, say for example, if they ask for the third year, what do? You take 3 over 15 into 6,000. So 18,000 divided by 15,000 will give you interest. So that this is what we do with the sum of digit method. So again, you can see you have to save time in the exam. You don't need to work out all 5 years because they're only asking for the first year. But if they have asked for the second year, then you have to work out for the second year. So you have to see what is he asking. 31/12/2021. 31/12/21 means our first year because we are entering into the lease on 1st January. And also we need to know whenever they talk about leasing, is the lease rental paid in arrears or is the lease rental paid in advance? Now, with the first payment due on 31st December 2021 means it is paid in arrears. So that's question number 2. So if any of y'all have any difficulty in understanding these answers, please send me a WhatsApp +94 77 321 9387. So let's look at question number 3. So I put up a lot of questions on scenario based because that's the style of the examiner. So this is why I have put up this type of thing. So My Lady PLC, an internationally trading company, wishes to borrow Eurobonds. So we know that if you are a reputed company dealing in the international market, we can borrow money in Eurobonds, that is foreign currency. At the next board meeting, you need to explain the concept of Eurobonds to non-financial directors, because some of these people, they don't have the financial background. They may not know what these Eurobonds are. Which of the following statements about Eurobonds are correct? Select all that apply. Now, select all that apply questions are typically difficult. You need to be very much focused, because even if you miss one answer, you might be not getting full marks. So, first one, they say they could be denominated in euros, which is correct. Eurobonds can be denominated in euros, can be denominated in any other currency. So not that they must be, they could be denominated in euros. In that case, that answer is right. My Lady will have to maintain a register of their Eurobond holders. No, not necessary, because Eurobonds are bearer securities. Whoever whose the certificate will get the maturity proceeds plus the interest. So therefore, the company don't need to maintain a register of their Eurobond holders. So that's wrong. Eurobonds are traded on international capital markets, which is right. My Lady will have to pay interest semi-annually. Generally, the interest are paid on annual basis, because it's their bearer bonds. You don't pay it semi-annually, it's paid annually. So that is wrong. They could be denominated in US dollars, yes. Eurobonds could be denominated in any currency, not necessarily only in euros. It can be designated in euros, it can be designated in dollars, it can be designated even in sterling pounds. So A, C, and E are the answers for the question number 3. So we have question number 4, bit of a big question. So generally in the exam, I will flag this question and go for the next question and next question. And then again, I come back, because it's not a difficult question, but probably I need to spend little time, because I don't want to get stuck in the 55th question, so that I don't see the 56, 57, 58, 59, and 6. Some of those questions may be easy, and where I can collect my that 2.5 marks. Finally, what you need is 100 marks. Don't stop it at 99, go to the 100 marks. So that 58 question may be easy. And sometimes if we get stuck in the 54, we will not be attempting, and that can be a waste of your money, waste of your effort, waste of your time. So Windsor Company need to procure a wood cutting machine, which will cost $1 million. As CFO, you need to decide whether to lease or buy the machine. Either of the decision is a must. In other words, you have no option to say that don't go with both. One of the decisions will have to be done. So whether we want to go for the leasing or whether we want to go for outright. So assistant has obtained the following details. Buying option, Windsor could borrow $1 million at an interest rate of 6% per annum. Machine will be used for 5 years, and it will have a residual value of 200,000. So in that case, what we do is we will take that 1 million, and it's an outflow. And then in the year 5, there will be an inflow of 200,000. And then we will have to look at the tax, whatever they say. We will take the tax relief, all that, and work through that one. Then we have the second one, leasing option. 5 installments of 250 will need to be paid, and the first installment payable in advance. So in other words, your installments will be year 0, year 1, year 2, year 3, year 4. Remember, in the earlier question, we saw it in paid in arrears, but in this question, it is paid in advance. Which the company would be responsible for any maintenance cost. Lease payment is allowed for tax purposes. So these are the two options available. So let's look at what are they saying. Other information, weighted average cost of capital is 12% for Windsor. Business risk will not change with this new machine procurement. Corporate tax applicable to Windsor is 25%. Depreciation can be claimed at 20% on reduced in balance basis. Which of the following statements are true? Select all that apply. The cash flows associated with the two options should be discounted at 6% of the debt interest rate. So go back to the question and see whether that is the right thing we should do. So buying option, if they go at an interest rate of 6%. So whenever we are evaluating a buying option and a leasing option, we must take the borrowing rate, not the leasing rate, the borrowing rate, but post-tax cost of debt. So what they are given is 6% is pre-tax cost of debt. So 6% is not the rate we should apply. It should be the post-cost tax of debt, right? So 6%, that statement is wrong. So I would say that statement is wrong. Right? So select all that apply, can't help it, we have to go to each and every. Maintenance goodwill be a relevant cash flow. It is not so, because whether we buy it outright or whether we lease it, maintenance cost will be there. So therefore, when you are trying to evaluate whether leasing or this thing, we can ignore that one. So that's not a relevant cost. Tax relief on the lease payments can be included in the cash flow. Yes, always the tax relief can be included in the cash flow. If there's lease relief, we can claim that one. Tax relief on the tax allowable depreciation would be a relevant cash flow. Yes. For outright purchase, we had the tax depreciation. For lease purchase, they might be giving the lease rent or whatever. That's also true. Third one, the first lease payment would be made immediately, which is true because they are paying it in advance. If you are paying it in arrears, it will be paid later. So the answer should be C, D, and E. C, D, and E answers. So this is how you must try and argue and come to conclusions of answers without spending too much of time. If you can do it, F3 is generally considered to be the most difficult paper in the strategic level. But if you are smart, if you can work out on exam techniques, you should be able to do it. So this is my intention. In next few sessions, I'm going to put up a lot of these kind of questions and I'll try to work through with you all. And if you're happy with this YouTube tutorial, you can subscribe to my channel, Cherry Academy Private Limited, and also Learn with Kumar. And you will have many more of these things coming up, which probably will help you to answer your questions much more broadly. Of course, I'll be doing for E3, P3, F3, and also I'll be doing for F1, P1, E1, F2, P2, E2, and even some other certificate level courses whenever I find time. If you need online tuition, contact me +94 77 321 9387 at individual tuition, where your weak points will be identified, attended to at very affordable rates. You can get tuition. Question number 5. Soft lock is evaluating the decision whether to lease a 3D printer or to buy it outright using existing funds. So in debt finance, you can see there'll be a lot of questions on this leasing versus outright buying. because IFRS 16 is relatively a new standard, and surely examiner must be testing us heavily on this area. Board needs an evaluation for them to make a decision. They will decide to procure a 3D printer. So no option for you to say don't take it. They will take it, but your decision need to be whether they should go for a lease or whether they should go for a outright funding. You need to advise what is the best discount rate to be used in the evaluation. So earlier also we discussed this one. What is the best discount rate to be used in the evaluation? It is always the post-tax cost of debt. Post-tax cost of debt. So answer is A. The post-tax cost of debt is the way that you will go forward. Pre-tax cost of debt is not the thing. Cost of equity is not the thing. WACC is not the thing. WACC we apply whenever we want to evaluate an NPV project. Cost of equity we apply whenever we want to measure the value of equity. Lease interest rate, we don't use it. We use always the post-tax cost of debt when we want to evaluate lease versus outright purchases. Question number 6. You are a senior manager at Skypen. The board has the option to buy a car for the CEO for US dollars 30,000 or to lease it by paying US dollars 12,000 per annum in arrears for 3 years. So arrears means you don't pay the first installment today, you pay the first installment after 365 days, what we call year 1. Today is 1st January 2021. So today is T0 and 31st January 2021 will be year 1. 31st January 2021, 31st December 2021 will be year 1. 31st December 2022, year 2. 31st December 2023, year 3. So here they are asking how much interest to be allocated for the year ending 31st December 2022. So that means they are looking for the second year. So again, what we have to look at is, okay, lease price is 36,000 because we are paying 12,000 into 3, 36. Cash payment is 30. So that means our finance charges are 6 and it is being paid in arrears. So when it is paid in arrears, you put 3, 2, 1, and then you have to work out the sum of digit. Sum of digit is n is 3 plus n plus 1 is 4 because there are 3 installments divided by 2. So it is 6. So now we are looking for the year ended 31st December 2022. That means I'm looking for the second year. So I don't need to worry about work in the first year and wasting my time. So I look at the finance charge. Total finance charge is 6,000 multiplied by 2 divided by sum of digit figure. How much is your sum of digit figure? 6. 3 times 4, 12 divided by 6. So this is my thing, and that will give me a figure of 2,000. So try to look for every little second of saving time, because you could have worked out year 1, year 2, year 3. Why should you work it out? You need only year 2 because December 2022 means year 2. So the answer is B. Answer is B. 6,000. We can work it out and get the answer. 2,000 is the answer. Sorry. 2,000 is the answer. Question number 7. Ranger PLC issued convertible bonds on 1st January 2021 to finance post-COVID-19 projects. So these days, one of the most popular source of finance is this convertible bonds, because most of the shareholders or potential shareholders they are adopting a wait and see policy. So if you offer convertible bonds, they might put their money in, because after some time, they can decide whether they want to convert it into shares or not. So they take a sort of a wait and see approach. So investors bond is given the option to convert into 28 shares or receive 100 cash either on 31/12/21, 22, 2023 or 2024. So the current share price is 320 and this is expected to grow at 3% per annum. Ignoring the time value of money, if you are a bondholder, when will the conversion would be worthwhile for you? So we have to find out, first of all, the price after 3 years. So you remember the compound interest formula, future value equals present value times 1 plus G into power N. So our present value of our share is 320. And if it grows up at 3% per annum, that means 1.03. So then we have to see, after 1 year, it is 1.03 into power 1. So what is the price? So 320 into 1.03 will be the share price after 1 year. 320 into 1.03, which is 3.296. And a shareholder will get, if he converts it on 2021, he will get 28 shares. So into 28, which is going to be 92.29. So he can get either $100 or he can get 92.29 in shares. So what will be his option? His option will be to go for cash. So the question is, ignoring the time of money, if you are a bondholder, when will the conversion would be worthwhile for you? So in 2001, that is 2021, it is not worthwhile. Right? It's not worthwhile. Then we have to look at the next year. Then what will be the share price? Share price will be 320 into 1.03 into power 2 into 28 shares. So we can work it out and see. 320 into 1.03 power 2 into 28 shares. How much will he get? 95. Still not worth. Still not worth to convert it, to go for the conversion option. Look at the next one. 31st December 2023. 320 into 1.03 into power 3 into 28. So let's look at that option. 320 into 1.03 into power 3 into 28. Sorry, into 28. How much? 97.90. That's also not worth. So actually, since there are only 4 answers, I know this is wrong, this is wrong, this is wrong. In the exam, I will even not work it out. I will just go and mark this as my right answer. But let's work it out and see whether it's the right answer. 320 into 1.03 into power 4 over 28. So now you can work it out and see. 3.20 into 1.03 into power 4 into 28. And you can see it's 100.84. That's the only point that it will be worthwhile for you to convert it into shares, because you're getting something more than 100. So in the real exam, I know because they are not given none or something like that, that you will never convert it. In that case, of course, you have to work out the 4th year. But here we don't need to do that one. We know 1, 2, 3 is wrong, and the fourth one should be the answer. These are the shortcuts what we need to apply in a situation like this. Question number 8 is a question that probably you might be able to answer within very, very short time frame. You are the bank manager of STS Bank. Your client Simco has approved the bank for a term loan. They have provided the ratio analysis certified by the auditors. Which of the following financial ratio is likely to be least interest to you when assessing the credit worthiness of Simco? So you are a bank, you are a lender. So what is the, so these questions you need to be very, very careful. I put it in capital letters, but it may not be always least interest to you. Gearing, lender will be interested. Interest cover, lender will be interested. EBITDA to finance charge ratio, lender will be interested, because anything to do with the finance charge, lender will be interested. Interest cover means finance charge divided by, or the profit before interest and tax divided by finance charge, which shows how many times they can pay the interest with their profit. EBITDA to finance charge is also, EBITDA means before depreciation and amortization. That's also a ratio which will tell us how much of profit they have to pay their finance charges. So all these three are very, very important for the lender. Operating profit margin is not something that he will be too bothered about. It's more relevant to the managers, because they are the people who are managing the company. So lease interest, I mean, they will be interested, but the first three ratios are more priority for the bank lender, bank manager, and they will be looking at the first three ratios. So we had a question number 9. You are the finance manager of Slimtex. You need to do a net present value calculations for lease in versus buy decision again. And you need to forward your report to CFO. You have calculated WACC to be 14%, pre-tax cost borrowings at 16%, post-tax cost borrowings at 12%, implied interest rate at 17%. Which rate you should apply? So earlier, so we came across a situation like this. Whenever we are looking leasing versus buying decision, the rate for discounting purposes is the post-tax debt cost of debt figure. So what is the post-tax cost of debt figure? Pre-tax is 16%, post-tax is 12%. So answer should be C. So even though the question looks very intimidating, with too much of numbers, you don't need to calculate anything. You just have to be rational, slowly think and give the answer, and you will get your full marks. So finally, let me look at the question number 10. Big question. TTPS issued tradables sometime back, subject to a covenant. I think it should be tradable debts. Yeah, tradable debts. Tradable debts means bonds. The covenant states clearly that the gearing ratio as measured by debt divided by equity. So remember, gearing, we can measure debt divided by debt plus equity, and sometimes it can be measured debt divided by. So look for what the examiner is telling. So examiner is telling debt divided by equity. Most of the time we use debt divided by debt plus equity. Both are right, but go by what the examiner says. Calculated on the market value. So we can calculate it on book values. We can calculate it on the market values. So they have signed a covenant saying that it should not exceed 45% at any given time. And the moment it is breached, the bonds becomes repayable immediately, which can be a very tough task for the management. So in other words, you should not breach the covenant. By chance, if you are breaching the covenant, you should be able to present something better to the bank manager or to the lender and get their blessing so that they will not enforce this covering, which can be very intimidating for you, which can be very damaging for the business. So today is 26 February 2021. Share price has fallen to 175. Company has 1 million issue. So equity value is how much? 175 into 1 million, 1.75 million. TT has a bond of 0.4 bank loan. TT has a 0.4 million bank loan. So bank loan, book value when the market value was same. So we will have debt, bank loan of 0.4, and the bonds 0.5 is the nominal value, but it is going at 88 per 100. So the bonds will be 0.5 into 88 divided by 100, which is going to be 0.44. So your total debt is going to be 0.4 plus 0.44, 0.84. And what is your equity? 1.75. And what's your gearing? As per this ratio, 0.84 divided by 1.75, which is 48%. So what should be our gearing target? 45. So we are breaching the covenant. So let's look at the question now. Actually, I should have looked at the question at the beginning because in another slide I didn't want to look at. Covenant breach, yes. So A, B, C, all three covenant breach, that means any one of those are possible. D, covenant not breach, so that means that is wrong. So that definitely I know it's wrong. So I have to decide between A, B, and C. Release news about lucrative new projects. That is one of the proposals we are having. Borrow more from bank to increase liquidity. If you borrow more, what happens? Your gearing will go up further. And that's not going to help your cause. Launch a share repurchase scheme. If you repurchase your shares, what happens? Your equity comes down. And that's also not going to help you. That's also going to increase your gearing. So both these are wrong. So the only possible answer is this one. And it's a reasonable answer because the moment you release news about a lucrative new project, what happens? The share prices will go up. And when the share prices goes up, equity will go up. And when the equity goes up, your gearing can come down. And that's a way that you can avoid a situation like what they were talking about. So I did these 10 questions as sort of somewhat a sample. I thought I'll help my students, whether you come for classes or not, doesn't matter. Every one of you, we want to become a CGMA qualified accountant. So we are prepared to help you. So anytime, if you want any assistance, you can just send me a WhatsApp +9477 321 9387. I'm Kumar Fernando, FCMA, Managing Director of Cherry Academy Private Limited, offering you online tuition with my panel of tutors, not only for CIMA and others, even for lower level areas like secondary education, science, maths, English language, English literature, ICT, whatever. We have tutors to provide your child, your sister, your brother tuition. And if you want CIMA, CCA, or any other topic, any other exam, please contact us and we will give you very, very affordable rates. And every weak student, we will focus very carefully in their weak areas. Our success rate is so good. Last November exam, Managerial case study, we had 100% success. Strategic case study, we had 100% success. F2, we had 100% success. P2, we have 100% success. P3, we have 100% success. We don't have too many students. In fact, we don't want to take too many students, but with few students, we want to see that we get good success rates. So thank you very much. I'm Kumar signing off from Cherry Academy LK at gmail.com. We are a company called Cherry Academy Private Limited, incorporated in Sri Lanka. If you are happy with this YouTube channel, put some comments and subscribe it. And you should have more of these things in the days to come. So thank you very much. Good luck. God bless every one of you.